I'm happy to share that once again, Mr. Hakimian is joining me here today. As always, we will talk about macroeconomics and the financial markets. Mr. Hakimian, thanks a lot for joining me here today again.
Thank you for having me, Elias. I appreciate being on yet again.
A lot has happened since the last time we talked. We live in this environment where every data point can really change the entire narrative. And that brings me right away to my first question here. I would like to talk a little bit about the volatility in the bond market. We know, of course, at the beginning of this year, the bond market was pricing in 6 rate cuts. Then, after the 50 basis point rate cut from the Fed, the markets continued to price in aggressive rate cuts. And then we got that strong September jobs report, and that really caused treasury yields to rise across the yield curve. I would like to know your opinion on, or just your thoughts on the volatility that we're seeing in the bond market and whether the recent moves that we have seen, the significant rise in treasury yields, whether you think that will sustain or whether, we might get a data point in the next few months that will push us in the other direction again.
Well, thanks for that question. I just, want to clarify, we're recording this October 24th. The 10-year is about 420, the 2-year is about 405 in that range. And this is about 1 month after that 50 basis point rate cut by the Federal Reserve. So I'm sure for all of those that follow me on LinkedIn and Twitter, this is probably one of my most loud opinions that I had at least a month ago. I thought that a 50 basis point cut would have been a tremendous mistake. It looks like so far it has been. I don't want to pat myself on the back, but it kind of looks like I've been vindicated to an extent. And let's just take it back to let's explain what I was thinking in September, why I was talking so loudly against doing a 50 basis point cut. The US economy is growing north of 3% real, which implies about 6% nominal growth rate. US fiscal deficits are about 8% of GDP. CapEx guidance is like guiding for like 20% growth in 2025 and even up to 30% if you look at like the AI hyperscalers. And then you just look at like what happened when bond yields fell even from like 4 to 380, like a 20 basis point move on the 10-year. You had this explosion in mortgage refinancing activity. So the totality of the data just suggested to me there's no need to cut. Like, how much better do you want an economy to be performing than 3% GDP growth, 4% unemployment? Inflation's a little bit above target, but like, okay. So I really didn't see any need for them to have done 50. And my entire point was if you do 50, you risk overheating this entire economy. We already are performing quite strong. Why do 50? What required a 50 basis point cut? And it happened, and bond yields have shot up. That being said, from this point on, like I think we're kind of in a decent range where look, bond yields, I think right now are probably fairly priced. And I'll just give you my explanation for that is that I think we're going to hit a terminal Fed funds of like 325, 3.25%, which kind of suggests that, you should have a 10-year about 100, 125 basis points above that, which means like 425 to 45 on a 10-year. Seems all right to me. I mean, I'm not gonna buy it because it just again, I think there's just I don't want to be buying bonds in a runaway deficit, risk to the inflation upside kind of world that we're living in. But so I'm not like gonna like vocally say like oh bonds are really mispriced. I was saying that a month ago. I'm no longer saying that. And then like I know you asked like is there anything that can change that? Well, let's just do all three scenarios. I think like for bonds to stay in this range is like if we continue getting good economic data, we can once in a while get something soft, like like one soft retail sales report. It's like that's just random movement sometimes. I think bond yields will stay right around this kind of range. I think something that might send bond yields lower, and we'll know this on November 1st. And again, I'm not going to trade around this. I'm just talking, what my thoughts are. We had two pretty big hurricanes in the United States in September, Hurricane Helene and also Hurricane Milton, and they affected some pretty big states, Florida, Georgia, North Carolina, and it wouldn't shock me if October payroll report, the jobs report for October, which is on November 1st, actually came out negative.
Mhm.
Not that I'm positioning for that, and I'm not going to trade around it because it's definitely temporary. But I wouldn't be surprised if that payroll report came out negative, and then we got a knee-jerk reaction, and bond yields fell, I don't know, 20, 25 basis points on that. Then again, I think that's all going to resolve itself in November. And then something that I think could send bond yields up further than this, and I think we're kind of beginning to price it in, just a touch, is if either party in the United States, the Republican Party or the Democrat Party, were to get total control of government. So to have control of the presidency and both chambers of Congress, the Senate and the House. Um, Current, like this is like 12 days before the election, the odds of a Democrat sweep are pretty low. The only reason I say that is because the odds of Democrats winning the Senate is just it's not their it just doesn't seem right with their map. Like so they could win the presidency and the House for sure. But the odds of them winning the presidency, House, and Senate are low. So we'd kind of just be in this kind of environment right here, which like what Biden has. He has presidency and one control of one chamber in Congress. So that's pretty unlikely, but definitely a Republican sweep, at least it's like a 40-45% chance of happening. That just requires Trump to win, which is probably like 50 to 60% odds of happening. And then the Senate seems like a lock. And then it would just be whether or not Republicans win the House. So if they do that, if they get all three chambers of Congress, that's going to allow them to spend more, which they will, tax less, which they will. The tariffs, the president can just do on his own or her own. So that'll most likely happen. And there's just a lot of things that are probably going to be inflationary, not to mention the fact that a Republican sweep would probably be perceived as pro-business, which would probably unleash some animal spirits. And these are all just inflationary, higher growth, higher nominal growth type of things. So that could be an environment where, like, if they act really irresponsibly with full control of government. I'm not a big fan of either party. I've told you many times, so I would expect them to act irresponsibly. That's the kind of scenario where I can see bond yields going up further. And yeah, that's basically my outlook on bonds from here on out. And
So
again, I'm not short and I'm not long bonds. I think they're more or less close to fair value based on all that we know right now, unlike a month ago where I was very bearish on bonds.
So that was a great answer because I think you touched upon three main points here. So on the one hand, of course, what's causing treasury yields to rise is the resilience of the economy and the bond market pricing out certain rate cut expectations. We have the Trump trade sort of that we're seeing on the financial market causing yields to rise, and also potentially a lot of bond issuance, right? So looking at all of these factors, how much do you think, how much of the recent rise in treasury yields can be attributed to sort of the expectation, also when you look at the betting markets, that Trump may win the election, and how much can be attributed to the strong issuance that we're seeing from the Treasury?
In terms of Trump, Let's just answer that because it's an easier answer. I don't think much yet, just because the House is still 50-50. Because Harris is probably going to win the popular vote, which, although it doesn't decide the presidency, the popular vote is highly correlated to who wins the House. It tends to be a lot more correlated. Whoever wins the popular vote, whichever party wins the popular vote for the presidency, generally wins the House. Not always, but it happens often.
Mhm.
So I don't think some of it might be because Trump's odds absolutely have gone up according to betting markets. So that's that. But I don't think much of it is that, because a lot of the things that like I would worry about, it's not about Harris or Trump. It's about them having full control of government. So, but even saying that, there is some of it that will be priced in for Trump because he's much more pro tariffs, and tariffs are undoubtedly inflationary. And tariffs in the United States, the president has a lot more leeway over implementing tariffs to an extent. He or she doesn't need as much approval from Congress versus, let's say, either raising federal spending or lowering taxes, which are both also inflationary. So that's that. But yeah, and then the second part of that question, I really think that the rise in bond yields is that people came around to my sort of position that, look, this economy is doing really well. Like cuts right now, if you're cutting into a hot economy, you're probably just going to make it hotter. Like, and frankly, I really think we've seen it. Even forget about just in like market pricing. I think economic data has actually shown it. Like the City Economic Surprise Index, which just measures all of them. So like non-farm payrolls, CPI, retail sales, industrial production, uh, real consumer income, all that type of stuff. And almost everything since that 50 basis point cut has surprised to the upside. So I don't even think this is just like animals. I think this is like the economy is performing too well to cut this much. And I've been saying this all year long. So yeah, I think a lot of the rise in bond yields in the past month has just been attributed to the fact that more people have come around to my sort of position,
Mhm.
not just mine, obviously, but the position that I hold, that the economy is too hot to justify this much rate cuts, and now bond yields are repricing a stronger economy.
Why do you think the economy is still so strong? And where I'm going with this question is essentially it sounds like to me you think the neutral interest rate is higher than the Fed currently anticipates, at least when you look at the median estimate on the dot plot. So where do you think the neutral interest rate is, and why do you think the economy is still so resilient?
So this is an interesting question. This is so let's just start. The Fed dots, I think they say 2.6. Correct me if I'm wrong, but I
I
think
think
they
two
say,
nine, but it's very wide
sorry, yeah,
range.
2.9. I think it's probably a lot closer to 3.5 than possibly even a little bit higher than that.
Mhm.
Um, and here's why I think that. It's not that like the efficacy of interest rates has somehow gone down, right? The mechanics of higher interest rates slowing down stuff is absolutely still there. I think what happened, and I've been saying this all along, is that so much of the country is locked into a 2.8% mortgage. It doesn't matter to them if Fed fund goes to 8%, or the Fed funds can hit 20%. It doesn't affect the guy and girl that have a 2.5% mortgage. So we don't have adjusting debt in the United States for the most part. It's only for like credit card debt and some other type of debt, maybe some like low grade borrowers, corporate borrowers take on. But for the most part, the majority of debt in the United States is fixed. And people took out debt, businesses took out debt when rates were really low, and they have no need to refinance it because they have 8 years left on the wall of that loan. So I just think that it's not just it's that not enough people are paying effective interest rates for it to be effective. I think um, that's the big issue with why neutral has to go higher. And then there's a second and third issue, but that I think is the first and foremost issue. The second issue is that the economy over time has just become less rate sensitive. Right now, the United States economy is almost three-fourths services and one-fourth manufacturing, goods, capital fixed investment, things of that nature. So all of that stuff in the one-fourth basket, that's the stuff that's very rate sensitive. When you go and get a haircut, you don't think what's interest rates. You just pay that with cash and you settle, or you put it on your credit card and you settle it, on the spot. When you go to the gym, you don't, think about what's interest rate. You think about what interest rates are when you're an auto manufacturer and you're considering how much to produce and how much you should borrow from a bank in order to produce that. But a lot of that type of our economy has moved to Asia, and we have chosen, and maybe it was a political decision, but we have chosen nonetheless to be more of a service-oriented technology, financial services, medical services, professional services type of economy, and that just is a lot less rate sensitive. So number one is that I don't think enough people are paying effective interest rates. Number two is that less people in general in the economy are exposed to interest rates just because of how we've shifted our economy. And then number three is that we have an 8% fiscal deficit to GDP. The
Mhm.
government doesn't care how much it pays in interest. It doesn't matter to them. They just spend, right? So, and between federal and state government and local government, 40% of the United States GDP is government spending one way or another. So that's 40% of the GDP that literally does not care what they pay for interest. And that's obviously gone up. That was in the high 20s pre 2008, and it was in the low 30s pre-COVID. So the more the government is involved in the economy, the less rate sensitive it gets because they couldn't care less what they're paying. And they're not, it's just, they're paying it either with borrowed money or with tax money, or in some cases with monetized print money via the central bank. So I think the combination of all of these things, I just think we're in a higher neutral rate world. If the Fed says it's 2.9, I think it's 3.5, 3.7, something like that. It's definitely higher.
Okay. So then let's say the Fed cuts to neutral, so 3.5%. Given that so many firms have locked in and also consumers have locked in low interest rates, do you think that then there is a risk in the fact that even if the Fed cuts to 3.5% to neutral, the average paid interest rate will still be higher in the economy? Do you think there is a risk in that?
Absolutely. I think this is the other part of excessive forward guidance, which is basically well, forward guidance is when the Fed basically, telegraphs for a long time what they plan to do and the logic is to allow people to get prepared, quote unquote, for it. But what happens when people get prepared, if they know rates are going to rise, they'll lock in rates now. So that's what happened in 2021. But to answer your question, yeah, let's just say let's just say I'm right for a second. Well, I might not be, but let's just say I am. And neutral is 3.5. Fed cuts to 3.5, and that gives you an average mortgage of like an average 30-year mortgage rate of like 5.5 to like 6, somewhere in that like 50 basis points range, depending on how much spread banks require. Let's just call it 5.75. Let's just split the middle. At 5.75, there is no reason for the person that's sitting on a 2.9% mortgage to refinance,
Mhm.
right? So if it went from 8 to 5.75, the only people that are going to really refinance is anyone that's above, let's say, 6.25, because you have to at least get 50 basis points to justify the time, the fees, the costs associated with refinancing your mortgage. So this is something I'm actually watching closely, in that yeah, it might not have as much of a stimulative effect on the way down as it was, prohibitive on the way up. But with that being said, look, there's also a certain amount of mortgages, corporate loans, leverage loans, everything that um, mature on any given year. And yeah, hey, if it matured, right now, and they had to borrow at 7.5, or if they get to borrow at 5.5 because the Fed pushes it down to 350, yeah, obviously that is going to be stimulative. So it might not look stimulative, but so it might not be pro-stimulation, but it might be anti-contractionary if you kind of get what I'm saying. Because if those guys that were locked in, those corporates that were locked in at 4% pre-COVID have to refinance in 2025, and now there would be refinancing at, let's say, 8, but now maybe they can refinance at 6, it's less contractionary at 6 than it would be at 8. So yeah, I do see I see both sides of the argument over there, and I'll just watch it closely.
Okay. Yeah, that makes a lot of sense. Um, I guess, you know, maybe this question may not be as appropriate given that you have already stated that you believe the neutral interest rate is higher. But I mean, the Fed's argument was when they cut by 50, we're going to make sure that we, don't fall behind the curve. We want to maximize the chance of orchestrating a soft landing. And we're cutting by 50 now because inflation has come down so much. So don't you think that no matter how resilient the economy may be, given that inflation has come down so much, that 50 basis point cut may still actually have been appropriate, given to how high the federal funds rate is relative to where inflation is?
So, you know, let me just clarify that look, the Fed's mandate is stable prices, which is they define it as 2% inflation and maximum employment. Their mandate is not GDP, their mandate is not corporate profits, their mandate is not the stock market, their mandate is not even bond yields. Their mandate is 2% inflation and stable prices. So yeah, obviously there is that argument that, look, why not just cut? Because, we're at basically what we want to be for employment, and we're rapidly decreasing in inflation. So why go any lower than that? But okay, so let's dissect. Let's crack open inflation and actually dissect what's going on right now. All right, services inflation is growing at 5% year over year in a straight line. Go on Fred St. Louis's website, go on Bloomberg, go on anywhere that can show you the type of data. Services CPI, services PCE, however you want to look at it, is in a straight line up at 5%. Why are we printing in the high twos for headline inflation and in like the low threes for core inflation? It's because of goods inflation and energy prices. Goods inflation has been falling by like 5% year over year, and commodity prices have been falling about 15% year over year. All right. The entire argument on the way up for being slow, which by the way, at the time, I actually, in the beginning, agreed with it. In the very beginning, I agreed with it. I quickly changed my mind, but in the beginning, I agreed with it. The entire argument for going slow was that the inflation that we control a lot more, services inflation, housing inflation, things like that, was not like 8%. It was more like 3.5, low 4, which is still a problem, but it wasn't as bad as that. We were inflated. We were at 8% inflation because oil prices spiked out of control and goods prices spiked out of control. I think what we have to realize is that, sorry, my apologies. If right now, if oil prices just forget about going up, if they just stay flat, and if good prices just stay flat. So if you have Western Texas Intermediate in the 70s to 75 range for the next year, and then you have China, Vietnam, Mexico, India, whoever's exporting, if they are, and also U.S. domestic manufacturers, if their prices stay flat and services inflation is 5%, we're going to be right back to a mid-threes inflation rate, right? the stuff that we actually control, we've hardly made any progress. I mean, if you look at a chart, it's almost the same, rate of inflation for services in 2024 as it was in 2022, right? So all I'm saying is the underlying economy, like what we're seeing, and this is the only reason why I actually bring up GDP, is that it's a very good indicator of what services inflation is going to do, right? Like nominal GDP growth is very indicative of what services inflation is going to do. We haven't really made all that much progress. All the progress we've done is stuff that was completely out of our control. My fear is that what's out of our control is eventually going to put oil prices are not going to go down 15% every single year. They're going to eventually plateau, right? Listen, maybe they'll go down more. And frankly, we need them to go down more. Our inflation projections are all wrong. But if those plateau, if goods prices plateau with all that stimulus that China's doing, with all the conflict in the Middle East, it doesn't seem impossible to me, like they can just at least, hey, they might even go up, right? But let's just say they just plateau. The inflation story is just, we're going to bring it back. And we're going to be talking about, next time I'm on your podcast, we're going to be talking about inflation again, right? And so that's my concern with cutting 50 basis points, is that I don't think we've actually made as much progress on inflation as we want to think we've made. I'm not saying the numbers are fake; they're real. I'm not one of those that says, everything. I'm not like that. But what I'm saying is, you crack it open, and it's like I can see exactly how the story gets written in 6 months, how inflation is back, and how we didn't, we didn't put the fire out.
But I guess you could argue, I mean, given that service sector inflation is quite sensitive to wage growth, right? I guess you could argue that given how much wage growth has come down, you would expect some more disinflationary pressures in the service sector. And also looking at shelter because of market rents that have declined, in the past, that will feed into the shelter component of the CPI. How do you think those two factors will play into service sector inflation in the coming
So look,
months?
wages are growing anywhere between like 4 and 4.5%. You want to annualize it. You want to take a 1 month annualization, a 3 month annualization, 6 month. Just take it's like anywhere between 4 and 4.5%. That's just not consistent with 2% services inflation. People make money and they spend it. And yeah, and then about housing, I'm gonna completely, I'm gonna completely agree with you. Yeah, housing inflation might be a little soft. And this is something I actually talked about a lot on my Twitter too. If you look at like Zillow's measure of housing inflation, or you look at like, CPI's measure of housing inflation, the numbers are so off. It's like one is showing 0% and one is showing 5% growth. Like it's just not acceptable. It's like one of the most important components of the economy. If it goes bad, it becomes the biggest component because most of uh, banking assets are related to housing one way or another, and banks are levered. And if they go bust, everything's going to go bust. It's just not acceptable to me that like the way we're measuring inflation, the way like the private sector measures housing inflation and the government is measuring housing inflation, it can't be 500 basis points apart. Like whenever this period ends, and when you and I have gray hair and they're looking back on the 2020s, they have to fix this. Like we can't have some people saying house rents are going up by 8% and other people are saying it's going down by -5. That's just not like gonna work. It has to be a uniform answer. And look, I think you can make arguments for both. I'm definitely going to err on the side. I think the private sector gauge is much more accurate. I don't understand at all why the BLS measures housing inflation. They basically ask homeowners what they think their house could rent for last year, and then again this year. Like, what? Like, why not just go based on what is actually just go on rents that were actually realized? Why are you like asking people a subjective question what they think their house can rent for? That just doesn't seem. I mean, would you ask a gas station company what they think their gas can sell for, you just ask what it sold for now versus last year. So anyhow, yeah, I agree with you on that much.
Yeah, let's see how that plays out in the coming months. But it is absolutely true that it's a sticky component. So let's see how that will play out. Um, Something that I've been wondering about is, especially after we saw that the 50 basis point rate cut from the Fed, we saw quite a significant rise in the price of gold, right? And I was wondering, what is causing this? Is it a sort of this expectation that we might see inflation reaccelerate again, or is it more of the notion that let's stay away from the long end of the yield curve because of the election uncertainty? What factor do you think is more at play here?
So I have to just, be transparent here. Since November of 2022, when gold was around 1700, gold has been my second biggest position, and we've only sized it up. We haven't really sized much of it down since then. So I just, I'm a bull on gold. So I just, take what I say with a grain of salt. But look, if you ask me, what is gold telling you? Gold is telling you that the Fed's going to make a policy mistake. They're going to cut too much. We're going to end up with inflation is not fully put away. So we're going to get rising realized inflation. At the same time, we're going to get lower overnight interest rates. AKA, we're going to get a lower, a zero, maybe even a negative real interest rate at some point in 2025. And when you get negative real rates, gold is going to explode, right? That's just the playbook since the beginning of time. Negative real rate. Nominal rates don't matter as much. It's real rates that matter for gold. So we took our position in gold in November of 2022 because that was just when real rates were starting to were getting a little bit restrictive, and we figured that as they got restrictive, they would get less restrictive over time. And if they did get less restrictive, gold was going to do really well. So yeah, I think that's definitely what gold is telling. That's the biggest thing that gold is telling us, that negative real rates, gold is going to, any hard asset is going to do great with negative real rates. I mean, think about it. Negative real rates basically means it doesn't cost you anything to borrow money in real terms.
Mhm.
So any other asset's going to do pretty well if you got negative real rates. That's one. Number two is that our fiscal deficit is absolutely unsustainable, and neither candidate gives one damn to fix it. I'm sorry, to be a little vulgar and to be frank, neither candidate, neither party, I don't care what the cable news channels want to say, like, neither party wants to fix this. They won't fix it because fixing it is going to get them, they're going to get unelected if they fix it, right? Voters are pampered. Voters don't care. Most voters don't realize any of this stuff. Voters are only going to see if if their benefits went down 10% and their taxes went up by 10%, which is how you fix this problem. So good luck trying to do that in this politics, right? You're never going to win an election again. You're going to be out of a job. So gold is also saying runaway fiscal deficits, and runaway fiscal deficits, one way or another, at some point is going to mean a growth in the money supply, and we're already seeing it, whether either via commercial banks or via the central bank. Via the commercial bank is a lot more healthier. Central bank is, spring of 2020, and so we're getting runaway fiscal deficits no matter what happens. There's no restraint from either party. And that just means, look, more dollars means each dollar is less valuable. And gold supply is growing at like 1 to 1.5% a year. Supply of dollars is growing like 6 to 9% per year. So it's just more dollars chasing less gold, and the price of gold is going to go up. That's number two. And then number three, again, and I've been saying this for a long time, I don't think China, I don't think Russia, I don't think the Turkish government, I don't think they want to add so much more exposure to dollar assets. Why? I mean, if America is going to sanction you every single time that you do anything they don't want, why would you keep your savings in their currency? Does it like I don't let's just flip this. Like some people get angry at me when I say this. Like, oh, you sound unpatriotic. Hey, okay, imagine us as Americans. Would we go right now and put our savings in yuan? Would we leave our savings in a Chinese currency? We wouldn't do that. We're not crazy. Like we know there's a risk that that money can get frozen. Why would we do such a thing? So China's not dumb either. Like, why would they put their money, their savings into dollar assets? And again, so since they don't really, I don't think they want to own Western assets. They don't want to own their own assets because that's going to make their currency too expensive and they're an export economy. They only have gold left. I think they've been the one that's been buying most of the gold. I think Russia's been buying a lot of gold. I think Turkey's been buying a lot of gold. The Saudis is a different story because the Saudis, have a defense, an informal defense agreement with the United States that they get military protection in exchange for settling all oil transactions in dollars. And they have so many dollars that they don't really have a choice but to own some type of treasury assets and or US deposits, things like that. So that's that. But yeah, I think for the most part, I don't think global South countries really want to own so many dollars right now.
So the last time we met, Mr. Hakimian, I think that was around back in June or July, you called for a steepening of the 2-year, 10-year Treasury yield curve. So you expected that as the Fed would cut, the 2-year Treasury yield would fall, 10-year Treasury yield would, kind of stay flat because the economy continues to remain quite resilient. And that happened. So that strategy seemed to work out quite well for you. Maybe you can just reflect on that and maybe just quickly also tell us what do you expect from here? What do you expect the Fed will do for the rest of this year?
Yeah, so I think we met like in the first week of July last time. The twos was around like 450 and tens were right around like 420. It was like negative 30 basis points inverted. And I had that trade on since like March, April of this year. And I was just expecting the yield curve as the Fed began to cut that it would uninvert and then I would take off the position. And it basically happened pretty rapidly, just like you would expect to happen in the textbook. It was a textbook steepening of the yield curve. Right now, twos are like 405 and tens are 420. So tens have barely moved and twos have fallen 45 basis points. So we were long the twos, duration matched, and we were short the tens. So that worked. And we've taken off the trade since then because it's normalized, so we don't care to own it much anymore. And beyond that, what I expect to happen, again, I've kind of already touched on it, but I just kind of expect bond yields, unless something drastic happens, in which case we should talk again, but kind of just to stay in this territory of like 4 to 425 to 450, and they'll move up or down, 25, 35, 40 basis points, depending on if recent data was soft or hot. But again, until we see something very big or something drastic changes in terms of government spending, I kind of just think we're gonna, just swing right around here.
Mhm. And maybe just very quickly, what rate cut do you expect at the December and November meeting? Do you expect a 25 basis point cut or no cut at one of the two meetings?
Um, November, I'm gonna have to wait to see the November 1st, the October payroll report, which is gonna come out on November 1st. So I wouldn't speculate on it, and December I wouldn't speculate much on either. But what I will definitely tell you, like confidently, I don't think we're gonna do 50 again in either of those. I think the Fed
Absolutely.
has a big egg on their head right now, and I don't think they're gonna do 50 again. I think they'll learn their lesson.
And I think that's a good opportunity to end the conversation. It was very insightful as always. And let's see, yeah, maybe the 10-year Treasury yield will be exactly where it is now the next time we talk, but it will definitely have gone through quite a roller coaster. That's
Yep.
for sure in response to all the data. All right. Thanks a
Next,
lot,
see you
Mr.
next
Kimian.
quarter.
See you
Thank
next
you,
quarter.
sir.
Bye bye.